All right, everyone. Hello and welcome to the Dividend Power Hour. We're going to have a little bit of a shortened edition of the Dividend Power Hour. So maybe it's only the Dividend half hour today, since we are coming up on the 4th of July holiday. For those of you here in the States, we had only a partial day here in the stock market. So we're going to go through some high level topics. Again, take a look at the market like we always do. Take some questions from those of you out in the crowd there. So if you do have any questions, let me know in the comment section. But let's begin by taking a look and letting me know, have you bought anything this week? Is there anything that you added to your portfolio? Let me know in the comment section, and also let me know, where are you tuning in from? So I'm here in Southern California area, where it is certainly heated up a lot. We're in the low 80s right now, so things are looking good for some nice weather for the 4th of July holiday. But for those of you that are out there, let me know, where are you tuning in from and what have you added most recently to your portfolio. So for those of you that are subscribed to our Stock Investors Edge newsletter, which is where I post all of my positions, I give you trade alerts. For those of you that have joined our Discord community, which is related to the Stock Investors Edge, there's links down below for those of you that are interested and wondering, okay, what stocks do I have? What am I buying? What am I selling? You can check all of that out, as we have a 30% special promo going on right now, and we'll talk more about that. But how are things going? I see Tom is in there tuning in from New Jersey. Tom, good to see you. Minnesota, we got Jeppy, and JepQ is being bought by John. Nice. Some good high yield right there. Someone's going yield hunting. Nothing really purchased on my end this week. Did a couple option plays, did some cash secured puts as it related to Tesla, and Tesla just surged this week. So we'll take a look at that. So got some good income there, but the stock did a lot better than the option plays there. Village Carpenter tuning in from Long Island, New York. So wrapping up their day over on the East Coast there, ready for that holiday weekend, or holiday day, I should say, since it is on a Thursday. Did I hear right? And maybe Village, you can help me correct myself, but did I see there's not going to be any fireworks in New York City this year? They're doing a drone show. Is that correct? Did I read that correctly? Because I always used to see, turning on the tube and seeing those 4th of July fireworks going off. And I read something on Yahoo today, and I know we can't read everything on the internet these days and take it at face value, but I did read that. So you probably have a better idea on whether that's true or false or not. So John Bircher, good to see you, my friend. Hope all is well. Tuning in from Tulsa, bought some SCHD, some triple Qs, J&J, Hershey's, and sold some Costco. John Bircher might have watched the latest video that we put out this week. So if you haven't, make sure you do tune into that, where I went over 3 different stocks. One I'm looking to buy, and I rate a buy. One that I rate a hold, where valuation isn't great. It's probably, right around fairly valued, not necessarily stock I want to sell. But then the third stock we looked at, I believe, is extremely overvalued, and one that needs to take a bit of a breather, let those earnings catch up, which is why I rate it a sell right now. And again, it's a company I like very much. It's a company that, you need to be able to separate a company from a stock price. And those of you that have joined the 6-week program, like John, you know that we've talked about this, discussing valuation from a company itself there. So Chuck, happy 4th of July to you as well. Sean, tuning in from Singapore, good to see you as always. Bought 400 shares of SIRI, sold some call options at a strike price of $3, and it rose 13% to $3.53. There we go. We like making money in options. Village said there will be fireworks. They moved to the other side of the city. Got it. So that was the news there. Again, King David got a question here. Would you consider dividend investing if there is a recession or a major pullback? I'm looking at Jeppy, some bonds, Exxon, and PepsiCo. So King David here, I'm a dividend investor, whether, the sun's up or the moon's up, or, I don't know what's going on. I'm a dividend investor through thick and thin. So it doesn't mean I turn a blind eye. I'm a diversified investor, and I like to focus particularly on dividend growth stocks. So it's a way to continuously get income from companies. If you and I go buy a pizza shop down the street and it continues to do well, those are paper gains as the company continues to rise. But if we had a bunch of cash within the company, we'd probably like to see a little bit of a return, actual return on our investment, because things can turn on a dime. Even the great Nvidia was down as much as 75% in 2022. Can you imagine being up huge in Nvidia, and then in a matter of days, weeks, or whatever it may be, like we saw in 2022, the market just, collapsed and it was down 75%, at least you're getting some sort of return. So, but again, doesn't mean I turn a blind eye. I own NVIDIA. I own Alphabet as my largest position, Microsoft, Visa. No one invests in those particular companies loving that dividend income because it's less than 1%. I focus on the dividend growth, but more importantly, those are going to be my growth stocks there. I have others that are going to be more middle of the road. You can think of things like Home Depot or Hershey's that John had just mentioned a second ago. Johnson & Johnson, AbbVie, those are going to be a little bit more income plays, but I'm looking, dividend investing is a total return strategy. So it's really going to be a sector performance. It's going to be a sector movement if we do, in fact, dip into a recession. So we may go from less cyclicals. We'll stay away from some of those higher growing type of companies and move to the more defensive sectors like a healthcare, like energy, utilities, consumer staples, things that consumers have to spend money on regardless of what's going on out in the economy as a whole. So I am loving dividend investing through thick and thin there. Tom bought some SPLG, some SCHG, and how about we just continue it with the Schwab? We'll go a little SCHD. And how about that largest dividend ever from SCHD? I did love seeing that hit the portfolio this past week here. Matt's tuning in from Indiana. We have some Starbucks, Johnson & Johnson, some O, and some PepsiCo, all dividend players right there. Other than Siri, I bought AVUV, IHI, XLK, and XLY there. Someone should look at Hess if they complete the takeover with Chevron there. So a little energy play there. Matthew, good to see you, my friend. No roll call here. There's no being tardy, so you're good. Buying some MPLX for the Village Carpenter. The J, good to see you. Let's go. Time for the Dividend Power Hour. Ben tuning in from Quebec, bought some Walmart and a little VOO. Can never go wrong with a little VOO. So again, today isn't meant to be the entire hour because I know it is the holiday time and everyone wants to go out and start celebrating a little bit or pre-celebrations, whatever it may be. So I don't want to hold you guys up. So I'm thankful that you're just here with me for the time that we'll have to spend together. So it's meant to be a little bit more of an open dividend power hour. If you do have certain questions, I'm going to take a look at some basic things for you guys because I do get a lot of questions on talking about stocks at a certain price. We talk about stock splits. I get a lot of questions on. So things like that, we're going to go to the iPad here today and kind of break those down a little bit more for your benefit. Try and learn something here today is the goal every time we meet with the Dividend Power Hour. So with that, let's do a quick update though, and let's see how the markets are in fact doing as a whole. So we'll add our iPad to the stage now and bring it in. So let's look at our year-to-date update. So we'll zoom in here just a little bit so we don't have to all use our magnifying glasses to see all of this. So we could see the info tech and communication services continue to lead the charge. They're up 30 and 27% respectively. No change from the last week that we met. And again, those are the only two sectors that are outperforming the S&P 500 as a whole, which is up 15.5% year to date. Next is financials, followed by energy. And what is our single laggard there? The only red sector year to date is sadly real estate. But we're going to talk more about that today and touch on some things that we have touched on in the past few dividend power hours there. So over the past 3 months, infotech, communication services, no real change from that standpoint. Utilities, consumer discretionary, but we do have more red on the screen when we look more recently. So we have healthcare, real estate, industrials, energy, materials, and even financials all in the red over the past 3 months. How about over the past month? Again, infotech continues to be at the top, communication services as well, but consumer discretionary is up there. A lot of that has to do with the performance of Tesla more recently this week and Amazon over the past few weeks there. And the worst performing over the past month has been utilities, materials, and industrials. So that's kind of a look overview of where we're at in terms of the S&P 500. So we've kind of talked about this before, and we've talked about interest rates. So we're not going to, beat a dead horse from that standpoint and continue to talk about interest rates and what's going to happen. But we've talked about how the REIT sector, real estate, is very interest rate sensitive. And some of those reasons is due to the fact that there's a big subsect of real estate investors, people investing in REITs, that are strictly investing for the high dividend yield. And again, to be a REIT, you have to pay out 90% of your taxable income to shareholders. That's one of the requirements. There's a list of requirements that they have to do. And then to be a REIT, once you qualify, you don't have any corporate income taxes. So that's one of the benefits, the main benefit of your company being a REIT, but they tend to pay higher dividends. So a lot of investors like to pour their money into REITs, especially retirees. But again, I'm not retired and I still like to invest in REITs. 15 to 20% of my portfolio is invested in the REIT sector, usually on an average year from that standpoint there. However, once we have a high interest rate environment like we see right now, we have a lot of those income investors that can go and get high yield savings accounts, get a 5% yield at relatively no risk. So why would they keep their money in REITs that are interest rate sensitive, that although they're going to get their dividend, they could see their capital appreciation fall? So we've had a bunch of that over the past few years, but we're going to see that reversal, which is going to lead to the outperformance I'm expecting over the next 12, 24 months from the real estate sector. They've been beaten down, and there's no doubt about it. Now, an interesting facet that we see here is the fact that we go to the front page of CNBC, and what do we got here? This is current right now. UBS sees attractive opportunities in real estate. Interesting. We've been talking about this for a few weeks now, if you're a regular on the Dividend Power Hour. So attractive opportunities. This is very interesting here. So if we read this here, the route in real estate has presented an opportunity for long-term investors. You would almost think that someone that wrote this may have been listening to the Dividend Power Hour. Probably not, but we'll try and toot our own horn, because I don't look at this as my show. I look at this as our show. There's a whole slew of you that are regulars on here, adding questions, adding commentary, and we all have one thing in common. We're all looking to build wealth from that standpoint, which is why I think this is the best show in terms of live on YouTube. So, I may be a little biased from that standpoint, however. So real estate is one of the 11 sectors in the S&P 500. As we saw, it was the worst performing here year to date. So if we look at what UBS thinks, is they think there's some outperformance ahead as the Fed starts to talk about interest rate cuts. We don't need to wait for them to actually cut rates. We're just waiting for a clear picture on, hey, I think we're ready to move forward with interest rate cuts. The latest commentary we got from Fed Jerome Powell was the fact that we have seen improvements, but we're not ready yet. That doesn't give us any indication. Again, when I say adding to REITs right now, we're not backing up the truck. We are nibbling at positions. You are getting a ton of high quality positions at great prices for long-term investors. If this is something you need in the next 2 years, it's probably not the best place. But if you're talking 5, 10 plus years out, you're going to look back in the next 12, 24 months and look back and say, I wish I bought more, fill in the blank with whatever high quality REIT that you may be looking at. That's at least my opinion. And again, not a financial advisor or anything like that, just going off my feel, someone that's covered the REIT sector for 15 plus years now. So what two REITs do they like? This gives me a little more evidence that they may in fact have been watching the Dividend Power Hour. How many times have we talked about PLD, which is Prologis, one of my favorite REITs, and Alexandria Real Estate, stock ticker ARE. So PLD is just another way for you to play the growth in e-commerce. Right now, e-commerce stands for roughly 20-25% of total retail sales, closer to 20%. If you go over to Europe or go to the UK, it's above 30%. So that's a growth trajectory item right there. And when you look at PLD, they have some brick and mortar type customers, and then they have a lot of e-commerce customers. Well, when folks go and do the e-commerce route, they tend to have to lease out 3 times as much space as a brick and mortar, which makes sense because if you have a brick and mortar store, you could probably keep some of your inventory at the store. You don't need to lease warehouse space, which is what PLD is. Their largest customer happens to be Amazon.com, which I don't believe is slowing down anytime soon. I love Amazon and I love PLD. 2 completely different ways to play the growth in e-commerce. Obviously, with Amazon, it gives you a lot of other growth drivers as well. You got cloud, you have advertising, you have the real estate, as well as many other things there. So there's a lot to be excited about, but we're not going to dive too deep here when it comes to Amazon here. But very interesting to see these 2 stocks on here, PLD as well as Alexandria Real Estate, which operates out of the healthcare. They have healthcare properties, office properties, but they've just been thrown into the office category, which has just been, mutilated since the pandemic hit. Now, some of them have recovered quite well because people have looked and said, oh, these are high quality properties here. people aren't just going 100% to work from remote. People still work, and those are continuing to climb. How many people are climbing up and coming back to the office? More traditional type styles, going back to offices that REITs own, that REITs are collecting from that standpoint. So I thought that was quite interesting. Front page of CNBC right now. It's like we knew we were starting the Dividend Power Hour. So what REITs are in your portfolio? You know, if you're to look at your portfolio right now, give me one or two REITs. If you own any, what are your top two owned REITs? So as you know, if you've watched any of my videos or been part of the Dividend Power Hour, you know that Vici is a big one. PLD that we just looked at is another big one. And it will very soon pass, if it hasn't already. I haven't updated the portfolio yet, but I did nibble some more at PLD, and those that are subscribers to the Stock Investors Edge know that that PLD is quickly approaching ready to surpass that of Realty Income. So in the comments section, let me know what is your top positions when it comes to REITs in general. So real estate, what are we talking about right now? Let me jump back up into the comment section, make sure I'm not missing anything. Matthew, speaking of REITs, bought himself some Vici. Love to see that. Jeremy bought some JEPI, JEPQ, SCHD, big time yields right there. Nick bought some JEPI, JEPQ, SOXQ, and SPIG. I do some minor option trading as well. Apple 222 call. I'm assuming that's a covered call there. July 5th cashed out with a 25% return. Love to see that right there. Jeff, good to see you. Minneapolis bought some JQPQ. Is that misspelled, or am I just not familiar with JQPQ? Hit that like button. Love it. Appreciate it. San Francisco, Sophia's in the house. Love to see you. Yep, Jared is. JEPQ. Some JEPQ. Love it. All right. Cal bought some SPLG and SOXQ there. All right. Matthew's got a question. Love to see it. I've been wanting to ask for quite some time. Always ask away. What is the purpose of stock warrants? And they are something to take advantage of. So stock warrants are another unique way for companies or investors, I should say. But again, this is a less version, so I will definitely add that to our Dividend Power Hour search, or you can just email me on the side. But it's not something that I've ever taken advantage of when it comes to stock warrants. So not something that I've seen a lot of interest in. There's many things that I haven't seen interest in that a lot of people on this Power Hour have. You know, things like BDCs and looking at stock warrants is now going to be added to that list as well. MLPs. Not anything that I've actually jumped into. More traditional, I guess you can call it old school type of investor of just buying stocks, ETFs, and index funds. But when we are ready for the Dividend Power Hour back to our full version, and I know Matthew joins on a regular basis, we will go, I'll try and do a quick high level version that'll make sense for everyone, whether you're brand new to investing or you've been investing for a while, because these gave me headaches in my accounting days when we were doing a lot of auditing. So I again, CPA here in the state of California, I worked for a large audit firm, and companies that had stock warrants did cause a lot of issues for us auditors there, but no one ever whines about the auditors by any means. So that is a fantastic question. And that's probably the first time I've ever been asked about stock warrants on the Dividend Power Hour. So that's something I'll definitely add to our list for next week and put in a slide for us when we get back to our regular slides there. So good question. King David, I think inflation is not as low as they say. Things like car or medical insurance is up more than 3%. That is a good comment. And when it comes to looking at PCE or looking at CPI, it's a calculation where everything has different weightings from that standpoint. So they're looking at the collective totality of everything. But yes, if you were to look at, and I think CNBC does some charts every once in a while that shows you how far up, and I think car insurance was one of the highest. That was well above 3%. But then there's some things at the bottom that are a little bit slower or even negative, which kind of offset. So like shelter is going to be one of the largest weightings in that calculation to determine what is the CPI year over year, what is the PCE year over year, and things like that. So yes, car insurance is well over 3%. But when it comes to the calculation as a whole, that's how that works out there. So B Hall picked up some Hershey's on Monday and some DG today. All right, so now we're getting into our REITs. What are the top REITs within your portfolio, if in fact you own any? Realty Income, Net Street, Vici for Matthew, King David, Blackstone REIT, Sean's with Realty Income, Vici, PLD and Vici, Only have small positions in Vici. Frank owns some Cube. Recession resistant. Say that 10 times fast. 400 shares of O, 115 shares of Maine. John's got himself some Vici and some ADC. I get my Vici dividend today. Michael, love it. O and Vici. Jay loves himself some Vici, O, and VNQ. So that's a good way, broad way to play REITs. You know, if it's not something, especially if you're keeping up with REITs on a day-to-day, then just buy the whole index. VNQ is a real estate specific ETF. So good one there, Jay. You know, I'm not a big proponent of ETFs when it comes to REITs, but that's just because I have covered the sector for so many years. And I want to own, you know, the 5 or 10 best REITs that are out there, and not really as concerned about owning, you know, a couple hundred REITs or anything like that. Skippy's going to get some AbbVie on Friday. So Friday could show us some fireworks there with the job reports coming out. Gary's top REITs are ADD, Stag, and some CCI. Long's got some ADC. I love that. Happy 4th to you as well. Thank you so much. Thanks for tuning in. DGRO, GEN, and WEN. How about O? Many thanks. You are welcome. We will add that. Stock warrants. Love it. Ryan's got a question. Loving that new merch in the back. Where can I snag a hat? Any subscriber to the Stock Investors Edge? We do some giveaways. I know John Bircher, I saw, is in right now, and he's got himself a Stock Investors hat. So we will start printing those a little bit more frequently for our subscribers. So good question. The hat is a big hit all the time on these Dividend Power Hours. Agree Realty for Steve. Sophia, Simon, and Realty. How about STWD? You guys are just crushing it right now. 30 SCHD added this week after a monster dividend. Awesome. Love to see it. All right. So now let me switch back over here, back to the iPad, and show you guys something else. So we just looked at, there we go. We just looked at what UBS thought. They're looking at real estate. Well, when we jump over here to Morningstar, 5 stocks to buy before the Fed cuts interest rates. And this is a very, as you can see here, a very long article that you have here. But just to give you the quick cliff notes within it, a couple of them are REITs. One of them being CCI, which I just saw mentioned a second ago. Who, in fact, mentioned that one? CCI. Got a lot of comments. I got to scroll through here. Well, one of you guys mentioned CCI. That is one of the ones that was mentioned here on this in this article here. So there's John right there. Love the hat. Awesome, John. Hopefully you're wearing it proud around town there. It's a good way to bring us, get yourself a referral and get us some more folks in there. So let's keep rolling here. So what did we get this week? We got a few other, economic reports, one of them being jobless claims. This is something I've been watching closely due to the fact that we've had a lot of folks worrying about the state of the economy. We just saw a massive run in the stock market in not only 2023, but so far in the start of 2024. But when we look, and last week we looked at some of those price targets, a lot of them don't have a ton of upside. There's 3 or 4, less than a handful or so that have, the high 6,000 price target when it comes to the S&P 500. But there was a lot of them were averaging out right around where we're at now. But at the same time, they're expecting a nice little move in the back half of 2024, which is where we're at now. However, leading up to that, they are expecting a pullback. And generally, we do see one pullback every single year. We get a correction of at least 10%. Right now, the biggest pullback we've seen is 5.5%, which we saw back in April. And I know people were going crazy because it was the first time we've seen that much red in what has seemed like 14 months. So we don't want to freak out. It's normal. It's healthy for markets, in fact. So we want to keep an eye, though, to see how is the economy doing. We don't, it's okay to have a regular pullback, a reset in the market. But if we have a pullback because we're heading towards a recession, that's going to be a completely different beast there. So we want to keep an eye on average hourly earnings. We want to keep an eye on GDP. How fast is the economy growing? How about jobless claims? Because if folks aren't able to keep their jobs and they go out on unemployment, they don't have as much discretionary income to go out and keep spending. And if consumers aren't spending as much, businesses aren't doing as well. If businesses aren't doing as well, stock prices aren't going to just keep going up from this standpoint here. So all these things we want to keep an eye on. Oh, yeah. And we want to keep an eye on inflation as well. So let's take a look over here at our jobless claims. And this is dating back to summer of 2022. So this is over the past 2 years here. But what we can see when looking at this is the fact that, well, we cratered out pretty much at the end of 2023. So if we go full page here and zoom in a little bit, we could see that right at the start, we were very low, pretty much the lowest we have seen since October of 2022. However, what has the trajectory been in 2024? Stock market's moving up, but are people paying attention to the trend that we're seeing here? We are seeing a trend higher and higher in terms of more and more people getting laid off, higher jobless claims. We are nearing the 10-month peak that we saw just a few months back here. So those continue to be high. We've seen delinquency rates continue to be high. We have seen company reports continue to talk about slowdown and what they're seeing, and they have great indication. You know, a lot of these companies don't report their earnings until 30 days after the end of a quarter. So let's say March 30th is the end of a quarter, March 31st. Well, they usually don't report another 30 days in. So they already have 1 month of data on what's going on in the next quarter. And when they're making commentary on slowdowns, look at ones that are specific to consumers who have talked about slowdowns. Starbucks. Okay, you could say maybe it has a more affluent type of customer base there in terms of the majority of folks there that can pay for $7 lattes. How about McDonald's? It's a good indication of how, you know, all consumers are doing. How about Home Depot? How about Lowe's? All of these companies coming out mentioning a slower consumer from that standpoint. So the big companies, the big technology companies that have the money to spend, sure, they're buying NVIDIA chips. They're buying more cloud space and coverage and things like that. So they continue to make money, which is why they're an area of defense right now. But other companies, the consumer makes up 70% of GDP. Without the consumer, we fall into a recession here. So keep an eye on jobless claims there, something you definitely don't want to just blindly go at. So let's look at our midweek wrap up. So again, down in the comment section below, you will see that we have a special promotion going on for our Stock Investors Edge. And I'll scroll down to that first here. You could see 30% off 4th of July sale right now. We've opened that up to the next 10 folks that are going to sign up. So you'll see a link down below where you can get your 30% off and just try it out. You actually get a 7-day trial right out of the get-go. And if you like it, stay with us, you get your 30% discount, whether that's annual or monthly, whichever you choose there. What does the premium subscription get you? Gets you instant access to multiple portfolios. In fact, it's going to give you weekly stock deep dives, earnings recap. We do the heavy lifting for you, whether you're working your regular job and just still want to keep up with the market without having to dive into it yourself. We're going to go through all of that stuff in those deep dives. You can join the Discord community. You get access to more in-depth rooms that are going to see the trade alerts. Anytime I buy a stock, anytime I sell a stock, I put a lot of my option plays in there as well. You're going to see those in the trade alerts. Now, the free folks that subscribe to the Investor Ed don't see those rooms. Only the paid, only our Edge Plus. So you can definitely, now's the time to try it out. There's a link down in the description below. But let's run through this. So we do our midweek recap. And again, you can see most of this particular report is part of the free version. So you can kind of see where has the market performed, what is the fear and greed index doing, and then we go over a few stories that have moved the market. So the Fed came out and talked about making progress when it comes to inflation. We already talked about that a little bit, but they're not quite ready. They don't have the confidence yet to start cutting rates. So that doesn't give us any closer to doing that, which is why, we see REITs that are, staying a little bit stagnant. We did see a little bit move higher there. How about Tesla? Any Tesla shareholders out there? Is Elon getting his mojo back here? So deliveries, after a massive decline there, shot back up to, a nice little spot. We were at 444,000, so triple fours there when it comes to deliveries, but still declined 4.7. So we're still on a trajectory downwards, but it was a nice little bounce off, and shares were up nearly 25% this week alone. And it's only Wednesday. So that has been fantastic there. So again, I mentioned at the start of this, if you weren't in here yet, that I had a cash secured put from it. Again, stock's up 23%, made all of my premium, but that stock was flying high there. So it was a good time to be a Tesla shareholder. And then how about Southwest? So Elliott Management is a well-known activist out there, owns roughly 11% of Southwest shares right now, looking to try and do some shakeups within the popular airliner there And Southwest, as you can see here, has adopted the poison pill. So again, if you sign up to the Stock Investor's Edge, this is one of the free versions that you get. We do a much more in-depth version for all of you that are Edge Plus members every single Monday. That's our Edge report. It's just another thing that you're going to get by signing up as an Edge Plus. And here's a whole list of other things you get: access to the portfolio, stock watch list. We do out a monthly stock watch list report going through 10 individual stocks. Again, I already mentioned the deep dive and the Edge report, as well as earnings recaps and access to special rooms within our Discord community. And whether you are a free subscriber or a paid subscriber, you can get in on that Discord community. Again, you can click on it right here and check that out right away. So that is that there for the Stock Investor's Edge and our plug here. Now let's jump into SPY. And one of the things that I wanted to focus on is this week in particular. I got a lot of people asking me about, why didn't I expect in the Edge report on Monday, I mentioned that I didn't expect much movement this week. One of those reasons is talking about volume. And I got a ton of questions asking about, well, how does volume play a role? And usually when I see a big move in the stock market, if I see a big move upwards or I see a big move downwards, I want to see it backed up by volume. Because if volume is quite low, that doesn't give me a lot of confidence that a lot of investors are buying that big swing up or that big drop. We're getting a lot of selling pressure going on from that standpoint. So big moves one way or the other backed up by high volume gives me a much higher conviction level. So where can you see some of this volume stuff? Well, let's look at the spider here, the S&P 500. This is on Yahoo Finance. They do a good job here. And you could see that they're going to give you their average volume. This is how many shares exchange hands on a regular basis. I believe this is a 90-day average volume. So this is per day. Usually we see 56 million shares. But as you could see today, this is going to be the daily one. We're only at 32 million only, but still well shy of that normal average. So let's say we saw a 5% move one way or a 5% move downwards, and volume was this much below their their regular average, 90-day average. Not something that I would have high conviction like, oh no, this stock is off to the races now. Let's jump in. If the roles were reversed, I would have much higher conviction. Let's say the average was 32 and today was 56. That's a big jump the other way. That gives you higher conviction as an investor there. So hopefully that makes sense. And now let's jump over and we're going to do let me jump over real quick and make sure I didn't miss any questions. Good point relating to VNQ. Hold it in one of my Roths. Maybe I'll sell and add to other positions since it won't trigger taxes. Yep. Once it's in your Roth, you got a lot there. Cybertruck. Jeremy, did you in fact buy a Cybertruck? Is that what you're saying there? We're going to have a Dividend Power Hour Cybertruck owner right here. And started buying some Lilly, some NVO, hoping I didn't buy at what's TG? Oh, top. There we go. Hoping I didn't buy at the top. Well, part of that is by understanding valuation. So I have no problem buying stocks at 52-week highs as long as valuation makes sense. I've been buying a lot more of Amazon, starting in the 170s, a little bit up to the 180s from that standpoint there. But that's because valuation was making sense, something that we dive into very deep within the 6-week program. So if you're ever invested in working with me one-on-one, check out my 6-week investing accelerator course. I have one spot open until we close enrollment here for the foreseeable future. So you can check out that link down in the description below and set up a free information call to go through all of that. So if you're interested in working with me one-on-one over 6 weeks, 6 sessions there, we go through portfolio construction, strategizing, action plan, and of course, analyzing stocks and going through valuation. The same exact way that I do it every time I buy a stock or every time I decide to sell a stock from that standpoint there. Peter's got a question. Peter says, Mark, are you still thumbs up for AbbVie? I'm assuming that means, do I still like AbbVie? I love AbbVie. AbbVie's one of my top 10 positions that I own. I think they have big upside. They're just going through that transitionary period right now where they lost their patent or patent protection expired on Humira, but Skyrizi and Rinvoq are proving to be the blockbusters that they expected. The growth has been tremendous. They still have their pipeline of newer drugs, but Skyrizi and Rinvoq are going to be the two big dogs moving forward. And management still believes that the two of them combined within the next 12, 24 months are going to surpass peak sales of that Humira, which, makes sense. It's 2 versus 1, but Humira was also the #1 selling drug in the world. So that's not any small feat. And I think that's what's going to drive AbbVie higher moving forward. The other thing is valuation. Look at the Mercks of the world, the Amgens. All of them used to have low multiples, 10, 10, 10 for years and years. Then it expanded to 12. Now you look at them, it's 15, 16. AbbVie's going through that expansion phase right now in terms of multiple expansion that we're talking about there. Oh, Jeremy is not buying a Cybertruck. He said, "No way." I've seen red ones. I've seen white ones out here in California. The very silver ones, not the regular silver, but the shiny silver. How they can, I'm starting to see a lot more, and my kids recognize them. They go, "Dad, there's a Cybertruck." I'm like, "Well, how do you even know that at 5?" Do you recommend buying and holding or taking profit and then rebuying during a dip? So first and foremost, I'm a buy and hold investor. But no stock is a buy and hold forever. It's always buy and homework. I'm constantly analyzing positions. If they grow to be too large of a position within my portfolio, I could consider selling. If the valuation is just completely doesn't make sense at all, like I talked about in my most recent video, for the one stock that I rated a sell, that's a time that I would cut the bait there. If my thesis changes, every time I jump into a stock, every time I buy a stock, there's a thesis on why I invested in it. Valuation, understanding the company, what's the upside? Maybe it's AI upside that hasn't been tapped, or with PLD, it's low valuation, e-commerce growth, and great upside with the expansion of e-commerce, but valuation, more importantly, the dividend, whatever it may be, have a thesis on why you're jumping into particular stocks there. What do you think about what Tom Lee has been saying about the market? It is very difficult to look and hear what Tom Lee says and say, I simply just don't see it, because the guy has been right more than he's been wrong. He has been spot on every time. And there's periods where you can't just be a bull all the time. And he comes out like that sometimes, but the thought process that goes through things, I think Tom Lee is less of a short-term investor and more of that long-term investor. And don't even get me started with the process of Kathy Wood and her team over there, which has just been lackluster, to put it nicely. Tom Lee has been, kicking butt, to say it nicely. He has just been fantastic. So it's hard to go against what Tom Lee says, given how he's been right way more than he's been wrong. I really wish Meta had gone 800 already. Metaverse, let's go. All right. So let me jump in real quick to what I was mentioning to you. This is going to be our little education piece of things right now. So one key question that I get a lot from investors is going to be around stock price. I get questions weekly basis, no joke, multiple times, talking about, "Hey, Mark, can you give me a few stocks that are below $50 per share?" And I always, respond back politely saying, "Why are we looking for stocks under $50 per share?" Well, I want to be able to buy multiple shares. Don't get caught up with buying multiple shares. 90% of brokerages out there now allow for what's called fractional buying. So let's say you had a $1,000 per share stock. And if you could only buy $100, let's say you were investing $100 today, you're going to get 1/10 of a share. And that's okay. There's no issue with that. I know there's a psychological thing that goes through, but there's no issue with that here. So let's take a look at an example here on the iPad. So let's say we have two stocks. One trades at $1,000 per share and one trades at $100 per share. And we are going to invest, let's say, $100. All we have is $100 this month to invest in each of these. Well, obviously, company, not sure what's going on with my S's today. This is going to be able to buy us one whole share, right? Everyone's happy with that. This one, though, is only going to be buying us 0.10 of a share. However, if both A and B go up 10%, they climb up in share price 10%, it's going to be based off of this number right here, how much you invested. You will be up $10 per share in both A and $10 per share in B. regardless of however many shares you own. When do share counts matter is when you're actually getting into options. Otherwise, if you're in the process of building up your portfolio, I want you to go find the best stocks that fit your strategy that trade at great valuations. Don't put yourself out of all of these other companies that could be fantastic. The Broadcoms of the world trading at what, $1,300, $1,200? I would much rather you go buy that than a $5 per share company that's just, a shot in the dark, highly speculative. Let's go buy high quality companies, even if it means fractional shares. Hopefully that makes sense from that standpoint there. How about stock splits? Let's go to that now. I get another thing I get a lot of questions on. I guess this isn't going to be a short version of the Dividend Power Hour. I tried, but I guess I just love being with you guys. So let's say, here's our market cap. Company A is going to be worth, we'll say, $100 million. Company B is going to be worth $100 million as well. We'll go price per share next, and we'll say this stock trades at $1,000 per share. And this stock trades at $100 per share. So the first takeaway here is a lot of people think the most expensive stocks price per share must be the most valuable companies. Not the case. Microsoft, Apple, and Nvidia are the most valuable companies. Okay. These companies here, you can see, they have the same valuation. They're both worth $100 million, but they have very different price per share. Why? Because they have different share counts outstanding. However many shares they have outstanding is how you calculate market cap, the value of the company. Let's say that stock A wants to do a 2-to-1 stock split or a 10-to-1 stock split, whatever it may be. All they're going to do is drop this. We'll do it by 2 and say now they're going to be trading at $500 per share, but they have doubled the amount of shares outstanding. So no change to this $100 million value right there, because all they did was they dropped their stock price in half and they doubled the number of shares. So when you calculate stock price times however many shares they have outstanding, it still equates to $1 million. And again, the only time it's going to be important on price per share is when we're trying to accumulate 100 shares, when we are involving options from that standpoint, because one option equates to 100 shares. So hopefully that makes sense there. Wow, Joshua, I'm like 3 weeks behind or something there. 1730 now on Broadcom. That is wild. I'm a happy Broadcom shareholder. All right. And now stock buybacks. So this is another question I get. There's 2 primary ways to return money to shareholders. You can pay a dividend or you can buy back stock. Apple has been paying roughly $15 billion in cash for the dividend that they pay out. They have also been buying back shares at an absurd amount. They have been spending for the past 3 years, on average, $90 billion. That number this year is going over $100 billion, almost 10 times what they pay out in dividends. But it's just another way to return money to shareholders from that standpoint. And that's stock buybacks is that second way there. So let's say we have both of our companies again. We have stock A and stock B, and we're going to say they're both worth $100. Probably only need one example here. We don't need both examples here. But let's say that they have 50 shares outstanding. 50 shares outstanding, which means this stock is $2 per share. That's what that one would trade at from that standpoint there. Well, if there's 50 shares outstanding, and let's say half of the folks wanted to buy back, they wanted to sell their shares out. Well, they can go out and sell it on the open market, or the actual business can say, well, we want to buy those back, and they can buy it. The business can buy it from the open market as well. But the business can buy back some of those shares and retire those shares. So instead of, let's say they want to buy 25 shares, well, now we'll come over here and say this is the same company, but we're going to update ourselves now. Now we're still worth $100. But instead of having 50 shares outstanding, we're going to have only 25 shares outstanding. So now I used to have $2 per share. Now you're going to have a $4 per share. And let's say this was like earnings per share or something. It would double the amount of the value of your specific stock that's out there in an earnings per share standpoint there. Your share is now more valuable. Why? Because there's less shares outstanding out there. You now own a larger piece of the pie for whatever specific company that we are looking at there. So just high level that we went through, questions that I get a lot, things that we touch on in much more depth with better examples than just ones that I just made up in the past few days here, or just winged. So again, if you're interested in understanding how to dive into the actual valuation, all the 8 to 10 different metrics that I look at, then definitely check out, because we only have one spot before we start to close enrollment for the summertime here. So definitely get that on the schedule there. Not taking any calls tomorrow, but we will be opening back up on Friday as well as early next week. Whatever works for your schedule, get that free call on there. So any other further questions from you guys? We're at 45 minutes here on this drummed down version of the Dividend Power Hour. Not going to make it all the way to an hour because I didn't want to hold you guys too long, but thank you guys for sticking around with me today. Let me roll through the comment section here and make sure I didn't miss anything in particular. We talked about Tom Lee. We talked about Meta. What's Steve got going on here? Celebrating a super long weekend and drinking Corona. I want to buy STZ, but it seems like they can't increase earnings per share despite revenue growing over the past few years. And that just tells you, if you have a company that's trending higher in terms of revenues, but the operating income staying stagnant, the net income or the earnings per share staying stagnant, that's the sign of a company that's becoming less efficient. So revenues are a great thing to look at. We want companies that have higher revenues, trending higher revenues. But more importantly to me, I want to find companies that are operating more efficiently, because then you don't have to rely as much on revenue growth. You could have slower revenue growth, but still see a higher bottom line if companies can find ways and management can find ways to be more efficient. So something to definitely keep an eye on as an investor. Is it a good time to buy Cisco? I don't own any Cisco right now. I haven't looked at it in a little while. I did, again, as part of the 6-week program, I actually let any student that comes through it, they get to choose 2 stocks we look at. And we use those 2 examples to go through those 8 to 10 different metrics, depending on the type of stock we're looking at, to determine valuation, to determine is the stock a buy, sell, or hold, to look at price targets and things like that. So it's probably been about 2 quarters now, so not updated on where Cisco is with their most recent. I don't own it, so don't follow it all too closely there. Sunny Man, late to the party. That's all right. That's why we have the live recording. You can go back and rewatch it there. Nice show, Mark. Look forward to another one. Yep, we will see you guys next week. And next week, just to give you guys a heads up, next week's version is going, the Dividend Power, instead of being on Wednesdays, it will be moved to Tuesdays, because we will be doing a live event. So I'll be hosting a live event. We're going to be going through my market update. So I do a free webinar once a quarter. We go through where was the quarter at, where are we at year to date, take a look at some of my top positions, some things I've been looking at. So it's just a high level overall market review. We have a lot of folks that come in. It's a chance to ask questions, to go through things a little bit more in depth than on what we go through in our regular Dividend Power Hour. Plus, we peel back some of my portfolio, something we don't do on the Dividend Power Hour. So if you're not already on our email list, definitely get on there. And one way to do that is by subscribing to the Stock Investor's Edge, which you can just subscribe to the free version if you want. But again, 30% off the paid one if you want to try it out right now, free for 7 days. We will be sending out those announcements here coming in the next few days. So be heads up for those if you want to be joining that free webinar that we have next week. Sunny Man's got a question. Have you started biting on Nike? I do own some Nike at these levels. So we got in it through an option play. Now we are in it and trying to wheel that. So selling covered calls now to the upside above our share price where we bought it. So if the stock does climb up there, we're going to gain in that share price. Plus, we're earning income along the way there. Great job, Mark. Thank you, sir. Jeffrey Hatch, good to see you. I'll have to watch the replay. Got caught up in some meetings. Hope everyone has a great 4th tomorrow. You too, Jeffrey. Good seeing you, my friend. Another graduate of the 6-week program. Michael Lee, 10 years to retirement with small amounts saved. Any advice to get over the fear of starting to invest heavy while the market is so strong? It's really going to come down to portfolio construction and valuation. So there's still a lot of stocks out there that are trading at great value. So, 10 years is a lot of time to work with from that standpoint. I usually think if someone's talking short term, they're talking within 5 years, but 5 plus, 10 plus years is something that you can really make some great headway with. So, if it's something that you want to work together where we put together a customized strategy for you, then check out that 6-week program down there where we have one spot left, Michael, and I'd love to work with you there. The J reminds everyone, like and subscribe. Let's go. Sean, thank you, Mark. Can we smash that like button? Love it. I appreciate the support, everyone. It was great being with you. For those of you here in the States, have a happy 4th of July. We will see you next week. And as a reminder, we will be here on Tuesday. So Dividend Power Hour special edition next week is on Tuesday. We will have that free webinar on Wednesday. So we'll be talking more about that in next week's Dividend Power Hour. Hopefully you can join us for the Tuesday edition and then even for the Wednesday webinar. Again, it's been great coming into your home or wherever you're watching. Have a happy and safe 4th of July, and we'll see you next time. Take care.